let tax revenues be the consequence of an expanded economy. And I must say that I was quite pleased when I heard the finance minister, because for starters, not a single new tax or an enhancement of tax has taken place. Nothing whatsoever. Far from it, the budget focuses on healthcare and increases drastically the quantum of money to be spent on healthcare, enhancing the healthcare, providing vaccination to everybody. The budget focuses on how the rural economy, the people staying in far-flung areas can benefit from affordable healthcare, etc. It focuses a lot on capex. It speaks a lot about investment in infrastructure spending. And in all of this, the focus and the thrust of the government is really to raise resources by disinvestment. So a fairly large sum, and I'm sorry to be speaking in Indian rupee terms, but about 1,75,000 crores is intended to be raised by way of revenues from disinvestment from sale of public sector undertakings. We have the initial public offering of Life Insurance Corporation of India. We then have proposition that 2 of the public sector banks will be privatized. And we have proposition that 1 of the 4 general insurance companies will be privatized. So a lot of those in the offing, and then it is proposed that the Indian infrastructure be developed on a public-private partnership. And more important, many of these assets, which are in the nature of highways, etc., be converted into a REIT or an InvIT and sort of be subscribed to by people. So really a lot of money being raised through those means rather than by enhancement of taxes. Very, very welcome. From a broad perspective, the GDP of the country for the first time is going to degrow, and that has been pegged at 7.7%. The growth next year is about 11%, which in effect means that for the 2 years, March 21 and 22 put together, we would have grown by just about 2.5% as opposed to 6-7%, which we normally expect to. There's a proposal to enhance foreign equity FDI into insurance from 49 to 74, which is a very, very welcome proposal in theory. But not all foreign insurance companies have gone up to 49 in the first stage, so 74 is something which is yet to go. More important, what we have seen is directionally a number of new proposals rolled out, which will really make India attractive to foreign investors. And given the fact that I'm talking to USIBC members, I would want to focus a little bit on those. So, for example, the government has gone on to provide ease of doing business in India, and many of the hurdles which were currently being faced have now been sort of done away with. Let me give you a few examples before I invite my colleague Rishi, who's going to deal with specifically all the direct tax proposals, and my colleague Ranjit, who's going to deal with the indirect tax proposals. So, for example, the last few years has seen the REIT regime in India considerably expand and billions of dollars flowing into Indian REITs and InvITs. One of the major challenges that REITs and InvITs faced was that on the dividend payout, there was a withholding tax. And then that withholding tax, because people are coming from different jurisdictions or were not required to pay taxes, had to be claimed by way of a refund. And that cash flow became a very major issue. What is now provided is that there will be no withholding taxes on dividends which are paid out to REITs and InvITs. So just shows how the government is reacting very quickly to those barriers which are faced by issuers of REIT and InvIT, and therefore making it far more attractive proposition. Similarly, on investment by FIIs in interest-bearing securities, the law provides for a withholding rate of tax of 20%. Clearly, if you are coming from a tax treaty jurisdiction and your rate of tax under the tax treaty is lower than 20, and if you were to suffer a withholding of 20, you might be waiting for a couple of years to get a refund, and that makes it very, very uneconomical. Personally, as an organization, we are working on a number of situations where only and only on account of this leakage, people have not gone ahead with transactions. What is now proposed is that the government will honor tax TT rates, which again shows the government's desire to meet its international obligations. All very, very welcome things. There are other propositions which concern non-resident investors. So, for example, and this is one is a negative one. Uh, we have authority for advance ruling, which, as you are aware, is applicable to non-residents, where non-residents can go and apply for a ruling. The authority for advance ruling had become a bit of a joke because the pendency of matters before the authority for advance ruling was almost about 5 to 6 years. And if you got a ruling after 5 to 6 years, well, the last thing you can call it is an advance ruling. So the request which were made to the government was, can you please expand the number of benches which are functioning for as authority for advance ruling? Instead, what the government has done is to scrap the authority for advance ruling and instead put a board of advance ruling comprising of only revenue officials whose orders are not final and binding. So we got into a situation where, because of our inability to implement what was a very welcome thing, we are actually scrapping it altogether, not something which is desirable. The final comment I would make is that the government seems to have forgotten that COVID has a significant impact on issues like permanent establishment, the concept of business connection that we have under tax treaties. We have situations where fund managers can constitute permanent establishment. So we have situations where people are stuck in India thanks to COVID, have not been able to move out. OECD has come out in January with a guidance note on what are the changes which are required to be made in order to alleviate the challenges which arise on account of COVID to the definitions of permanent establishment and the like. Somewhere along the line, this seems to have totally bypassed the revenue officials, and they seem to have totally ignored the whole thing. I'm very sure representations will be made, including by our organization, by FICCI, etc., and invite government's attention that they need to address this issue. But overall, a fabulous budget, all in the right direction, with a number of proposals which are very, very welcome. With those initial remarks, if I can now invite Rishi to come in and start his presentation on the specific direct tax proposal. Rishi, please.
Rishi, we can't hear you. Rishi, are you able to take off your microphone? Jay, yeah.
Sorry, I think there was a bit of was on mute for some time. So a very good morning to everybody. And as Dinesh said, that this is quite a welcome budget where the government has focused on expanding the economy, attracting investments into India rather than raise taxes. There are no changes in the corporate tax rates or the personal tax rate. So there was a lot of fear amongst all the stakeholders that there would be a wealth tax, inheritance tax, new levies, a COVID cess, but thankfully there have been no new taxes that we've seen. There has been a whole thrust on attracting investments, on promoting sectors. And just to give a glimpse of that, we would see that there is a host of incentives that have been offered for the IFSCs. So in response to promote the IFSCs and our response to the Mauritius and Singapore-based funds is that the government has said that there will be an exemption from capital gains for funds that would be migrating from an offshore location into an IFSC, provided that the migration is undertaken before March 31st, 23. Not only that, there is also a subsequent capital gains tax exemption to a non-resident investor on the sale of the shares of the Indian investee company by the fund. So this move is clearly to promote investments and to promote a relocation from offshore locations into an IFSC. Also, the losses which will happen on account of such relocation of the investee companies, those will not lapse on such relocation. So that's one incentive on the IFSC. Moving on, there are other tax exemptions for IFSCs. So if you have there is a capital gains tax exemption which is available for dealing in specified capital assets, namely debt securities and derivatives, which arise for the investment division of an offshore banking unit. The offshore banking unit has to be registered as a Cat 3 as a Cat 3 AIF in the IFSC. The unit has to commence operations on or before 31st of March 24. Again, income arising to a non-resident from transfer of non-deliverable foreign contracts entered with an offshore banking unit of an IFSC is also exempt. Royalty income arising from aircraft leasing to a unit in an IFSC also enjoys a tax exemption. The tax holiday in IFSCs, so if there is an income from the transfer of an aircraft or an aircraft engine which is leased to an IFSC unit, that will also enjoy a tax holiday. It's similar that the unit has to really commence operations on the 31st of March 24. Another important amendment where the government has in a way to expand the avenues for investments by some of the sovereign wealth funds, pension funds, is that the government is basically laid down 3 categories for investment. So you would have the sovereign wealth fund or the pension funds really invest through the AIF route, or they would invest directly into a domestic company, or they could invest through NBFCs. So the move here really focuses on attracting investment in specified businesses, which would basically be in infrastructure development sectors. So if there is an investment which has been made in a AIF, and if the AIF in turn invests a minimum 50% in specified business, then the sovereign wealth fund and the pension funds would be eligible for a tax exemption. Just to note that the minimum investment criteria was earlier 100%, has now been brought down to 50%. So clearly quite a welcome move. Again, investments in a domestic company, which is in the threshold of the minimum investment, is 75% in specified businesses. Investments in NBFCs, which are registered as an infrastructure company or an infrastructure debt fund, is also covered by this incentive, provided that they in turn lend minimum 90% to specified businesses. Of course, the exemption is prorated depending on the quantum of the investment that has been made in the specified businesses. Some other amendments in connection with sovereign wealth funds and pension funds is that if the pension fund has loans or borrowings directly or indirectly for making investments into India, then they shall not be eligible for making investments. Another important aspect was on what is the condition for not, it was very important that the sovereign funds, pension funds should not be liable to tax. The term liable to tax could have been is subject to different interpretation. It has now been provided that liable to tax has been clarified to say that if the the law in the overseas country taxes a fund but provides for a specific exemption, it will still be considered as liable to tax. So that's pretty much how it is interpreted in a treaty context. So that's again another welcome clarification. There was also a condition attached for a commercial activity to be undertaken by a sovereign wealth fund, which would not entitle them to the exemption. The commercial activity condition has been removed because the word commercial activity itself is so wide and ambiguous. So that condition has now been removed, and a new condition has been put in that the exemption incentive would be available provided the fund is not involved in day-to-day operations of the investee companies. It has been clarified that if the activity is restricted to investment monitoring and appointment of directors or executive directors for overseeing the investments made, they would not be considered as involved in day-to-day participation in the investee company. Moving on, some other relaxations which have been brought about is the safe harbor rules for fund managers. So if the fund manager is, there was always a problem with the tax residency and trigger, as well as the fund manager being considered as having a place of effective management out here in India. There have been relaxations proposed from those conditions if the eligible fund manager is located in the IFSC. One of the biggest changes has probably been on the withholding tax. We had a Supreme Court decision which said that if there was a withholding tax, then it is the payer has to withhold tax at the rate which is provided under the Act, and the foreign recipient can file a return and claim the treaty benefit and take the lower rate as per the treaty. Now, this was a huge problem, and just when the government abolished dividend distribution tax last year, they put a withholding tax on dividend declarations. So there would be a tax withholding on the dividend payouts from Indian companies to the FPIs. This was a huge issue because there would be a high withholding of more than 20% on the dividend payouts. The government has stepped in to provide that the withholding tax payments to FPIs will now be circumscribed by the tax treaty rates, whichever is beneficial. Again, as Dinesh spoke on REITs and InvITs, there was a cash flow issue in terms of the withholding tax on the dividend income paid out by the SPVs to the REITs and REITs in turn to the investors. So it has now been, they have now provided for an exemption from withholding tax with effect from April 1, 2020. So these are some of the incentives that have been, or clarifications, which are quite welcome in this year's budget. One of the most, perhaps the most important amendment which has been brought about in this year's budget is the whole depreciation on goodwill. We had a Supreme Court decision in case of Smith Securities, which kind of blessed that goodwill could be considered as an intangible asset eligible for depreciation. Based on this decision, many organizations undertook restructurings internally, or there were acquisitions where goodwill generated on such transactions were considered eligible for depreciation. Now the government has come in and said that from FY 2021 onwards, goodwill, even if it is an acquired goodwill, will be ineligible for a depreciation claim. There seems to be some ambiguity if one looks at the fine print and the memorandum on whether depreciation on goodwill will be available even for past years. So this would have a huge impact on a lot of the transactions, on the internal restructurings that have been undertaken by corporates out here in India. The cost of acquisition of the goodwill will be calculated net of depreciation that you've claimed till the last year. So this will really have a huge impact on a lot of the transactions and deals that have been done over the past few years, and how it changes the entire IRR calculations for a lot of these transactions. Also, how it really impacts. Many of them would be already undergoing litigation before the tax office. It'll be interesting to see how this all pans out, and how the government reacts, or how the tax department reacts to these amendments and its impact on the litigation that's going on. So that's something which will have a huge impact, and one must really look at what if there has been a depreciation on goodwill claim, then how would this impact for past years as well as on going forward years. On a small amendment is in terms of a permanent disallowance in case of a late deposit of employee contribution to a provident fund. There has been a rationalization of MAT provisions. Now, the MAT provisions, some companies would still continue under the old regime of the tax rate of 35% as well as MAT. So wherever they are under the MAT regime, it has now been clarified that the dividend income will not be included while computing the book profits of a foreign company. There was also a concern on how would you really compute the book profits, especially where there have been APAs entered into, and there have been adjustments on account of the APA. So then how would you really compute the book profits? It's been clarified that you can make an application to the AO for recomputing the book profits for the past years, and a proper mechanism would be determined for determining the MAT payable for such years. So that's some of the things. There was another interesting element on what we call slump exchange. So a lot of the internal restructurings as well as M&A deals involve slump sale of businesses. Typically, if there was a slump sale for a cash consideration, it was considered as taxable as capital gains. There were certain precedents which said that if there was a transfer of a business on a slump sale, or a transfer of an undertaking on a slump sale business in exchange for a non-cash consideration, say shares or preference shares from the purchaser, then it is not really a slump sale, but it qualifies as a slump exchange. And there are no mechanisms for computing of a slump exchange. Therefore, it is not liable to capital gains tax. Now, this was being, there were certain precedents, including the Bombay High Court, which kind of blessed this proposition. It has now been, this has been plugged by the government, and it has been made clear that the slump sale definition would include a transfer of the undertaking by even non-cash consideration. The government has made it very clear that you have to look at the substance of the transaction rather than the nomenclature attached to a transaction. So this would again impact many of transactions where people have taken a position that a slump exchange is not in the nature of a taxable capital gain transaction. Another interesting, while this may not really be applicable to a lot of the MNCs, but where there has been a reconstitution of partnership firms, or there has been a retirement of partners, that would also now be considered as a taxable transaction, and it would be liable to capital gains tax. So these are some of the provisions on dealing with capital gains taxation. Moving on, there was a TCS, tax collected at source, which was introduced last year. This created a lot of hue and cry amongst the payers out here, and also it became very complex to kind of implement the TCS provisions. The government has now has replaced the TCS provisions, because earlier the TCS would really be the liability of the seller rather than the buyer, and it was becoming very cumbersome for a seller to comply with such transactions. So it has now been provided that it is a buyer who will be liable to TDS. So TCS would not be relevant, and TDS of 0.1% would be applicable on payment exceeding 50 lakhs for purchase of goods. So and in a sense, it really makes it easier, because because all along withholding tax provisions have worked in a manner where the payer is under an obligation to withhold tax. So therefore it makes it easier for a purchaser to really comply with the TDS provisions. If no permanent account number is furnished, then a higher withholding tax of 5% will be applicable. Again, there are higher TDS and TCS provided if the taxpayer has not filed tax returns for 2 preceding years and the time limit for filing such returns have elapsed. And the TDS would really be 2 times the applicable rate or 5%, whichever is higher. So this would be effective from July 1, 2021. This makes it very important for all payers to obtain declarations from their vendors or to parties to whom payments are being effective where TDS is applicable, to take some declaration from them that they have been complying with tax filing requirements and that returns for the past 2 years have been filed, or else they would need to withhold at higher rates. Equalization levies. So equalization levy was the surprise move which came in last year, and this was introduced just when the country was undergoing the COVID lockdowns. The equalization levy was introduced and it created a lot of ambiguity and and a lot of issues in terms of how equalization levy would pan out. There was also an issue in terms of there being a dual levy where there would be a withholding tax applicable as well as the equalization levy applicable on certain payments like royalties and fees for technical services. It's now been provided that if there are amounts that are taxable as royalty or FTS under the Act or the treaty, then they would not be liable to equalization levy. So in a way, the government has said that royalty and FTS taxation under the Income Tax Act or the treaty will supersede equalization levy. So that makes does away with the dual levy aspect of equalization levy as well as the income tax. Again, moving on to the equalization levy provisions, it is now being provided that it has rather been expanded to include even an acceptance of an offer for sale or just merely placing a purchase order or payment of consideration online. So the clear mere definition of online sale of goods and online provision of services has been expanded. There was an anomaly the way when the equalization levy was introduced. It provided for an income tax exemption only from April 2021. It seemed like a typo error last year, but no clarification really came in the whole of last year. However, now it has now been corrected to say that the exemption from Income Tax Act will apply from April 2020. There have been certain rationalization of due dates. So the last date for filing of belated returns or revised returns has been reduced to, from the earlier it was right till the end of the relevant year. It has now been reduced to just 3 months prior to the end of the respective assessment year. There has been a reduction in the time limit for completion of a summary assessment from 1 year to 9 months. The time limit for issue of notice as for an audit has been reduced from 6 months to 3 months from the end of the financial year. The completion of the assessment for AY for FY 1920 and subsequent years will now be 9 months from the end of the relevant year. Another important change on the audit and assessment related procedures has been on the time limit for completion of reassessment proceedings. So earlier it would go that you would have the tax office had a timeline of at least 6 years. They could go back 6 years and issue a reassessment notice. It has now been reduced to 3 years. So therefore it's quite a welcome change, because it doesn't mean that it is always a huge problem to go back 6 years, provide all records, etc. There has been a process notified for initiating a reassessment proceeding, and a reassessment proceeding cannot really be initiated unless it's been approved by the higher authorities. Certain incentives for startups, and there has also been for the government has had a huge a disinvestment target for public sector companies. It's been provided in the Act that where there is a strategic disinvestment of a public sector company, the losses will be eligible for migration on merger. So that's another important. There have been several other procedural changes. Dinesh broadly talked about the constitution of the Board of Advanced Ruling, which will now comprise of more of higher of retired income tax administration commissioners. There is a faceless scheme introduced for income tax appellate matters. There's a faceless dispute resolution scheme for small taxpayers. Certain relaxations on not levying interest for shortfall in advance tax payments in connection with dividend income which has been received. And certain small changes. I think that's for me to summarize all the direct tax proposals. I'll now hand over to my colleague Ranjit to cover indirect taxes. Thank you. Over to you, Ranjit.
Thank you, Rishi. Warm welcome to all our participants today. I've got two sets of proposal amendments that I need to sort of take you all through. One deals with the goods and services tax that we have, and the other deals with the customs levies. Taking up the GST first. There have been some legal, or I would say, amendments made to the law, which otherwise would not have been possible in the course of the Parliament not sort of functioning. So the first one that we have, and interestingly, this in a way clarifies an issue which the Supreme Court had sort of ruled on a little over a year ago, in the context of our sales tax and service tax law, which was before the GST regime. And a sort of doubt that emerged thereafter, that whether the transaction between a member and between a member or constituent of a club and the club itself is liable for GST. The amendment that has been proposed in Section 7 of the GST law effectively puts to rest that doubt, and those transactions will attract a levy of GST. A significant amendment which we have concerning input tax credit is in Section 16, which is the next point that we should be concerned with, and this is I would say a one which has been troubling trade and industry for quite some time, because there were effectively 4 requirements for a taxpayer to take credit. He should have had the invoice, he should have received the goods and services, he should have made the payment to the supplier, and effectively he should have filed his own return. Now, there were certain amendments which were made to the rules, or certain other requirements which were brought in through the back door, I would say, which effectively required a matching to occur of the amount of tax that you wanted to take as credit and that which was provided and uploaded by the supplier to you. The amendment that is now brought in effectively nails it down to say that if that supplier provides you the invoice, he must also make a return of that and uploaded that into the GSTN portal. And such communication also will have to be made with you, the taxpayer who's making the procurement. Now, this communication would be in the form of the 2A and 2B sort of register ledger, which you would have and which you would effectively put down. So with that, the sort of matching is becoming far more important, and in fact will result into ITC not being available in case there is a an issue on non-matching. A small sort of procedural change is the requirement to have an annual audit done and a reconciliation certified by a chartered accountant. That has been done away with, and that would come into effect from the next fiscal period, which is 2021. Talking about the next sort of big issue which we would have in GST is where there is a mismatch between the GSTR1, which is the outward supply return that would be filed by a taxpayer, and the GSTR3B, which is effectively the tax payment return. Now, if there is a mismatch, then there is a recovery which can make which can be made directly by the tax department, effectively without going into the process or lengthy proceedings of making a show cause notice and then calling for a hearing and things like that. So taxpayers will have to be very careful to ensure that there is no mismatch of this kind, lest it sort of result directly into a recovery proceedings and that becoming sort of a pain point in doing business. The next amendment that we have concerns the IGST Act, which is our Integrated Goods and Services Tax Act, which effectively is the one dealing with the cross-border transactions. Three sort of broad changes there. One is that the option to pay tax and export goods and services has been taken away with, except in situations where they prescribe so. The second is supplies to SEZ, which also qualifies as a zero-rated supply, will be available as to be zero-rated only when it's for authorized operations, meaning you have to reach out to the party which is procuring it and ensure that he has it in his authorization to require and get those goods and services. And the third one is that for goods that are exported, there is a time frame which the FEMA law prescribes for receipt of the foreign currency for foreign exchange. That has now been sort of brought into the GST law as well. Effectively, if you have received a refund for having made an export and you have not collected the foreign exchange for that, you would have to pay back that to the government, and that's effectively the amendment that's been proposed. The next set of issues are concerning the customs duty, and I think the broader sort of comment there is that there has been certain amount of thrust that the budget overall tries to make on the domestic manufacturing, and in that context there have been certain exemptions which have been withdrawn, there have been certain duty rates which have been hiked, and we would see therefore effect for renewable energy sector, the auto sector. There are also certain other measures which are trade facilitation measures, and I'm not going to sort of labor those over here now because there are quite a few of those. But on the rate regime, I would make 2-3 points. One is the certain amendments that have been made in terms of the hiking of the rate so that the domestic manufacturing sector gets its necessary fillip and boost. The other is the introduction of now what's going to be the AIDC, or the Agricultural Infrastructure and Development Cess. This is at the moment on 25 product categories. And effectively, the way in which it has been administered or will be administered effective 2nd of February is that the basic customs duty has been reduced. So on an overall basis, the rate would not change from the time that the AIDC comes in, because the BCD has been lowered in that way. The other amendment which concerns rate and effectively is an interesting development is that exemption notifications, wherever these are conditional in nature, would have a lifespan of 2 years from the time that they are introduced or that they are varied. And that 2 years would sort of run into the following 31st March. Now, this is something which has not been done in the prior period of the customs law in India. And it's interesting that such a development has come about. A useful sort of amendment is that concerning the issuance of show cause notice within a time frame from initiation of the audit or a search or seizure and summons are issued by the Customs Department. Very often there were situations where the investigation wing, the DRI in the customs would sort of make its inquiry through the pressure that it would exert, collect tax collect the duty, and then sit tight on that case, and there would not be a show cause notice which would be issued, and the proceedings would therefore just be in cold storage. With this amendment that is proposed, there will be a timeline that the Customs Department would have to effectively abide by, and that would make it necessary for them to issue the show cause notice and effectively bring to closure that proceeding so that it can move to the next phase, which is the adjudication phase. The next sort of amendment that we could go into is that concerning the bill of entry. Till date, you could file the bill of entry up to 1 day after the arrival of the goods. You could file it prior to the arrival itself, but it was possible to file it 1 day after as well. As of now, the amendment proposes that this must be filed 1 day prior to the arrival of the goods. And if it's a holiday also, it would not matter because you would have to still file it within that time frame. And in that way, it seems that the workload at the customs port is sought to be sort of administered and better handled. The last point that I would talk about is the fact that the HSN 2022, effective from 1st January 2022, will be brought in. And in that context, there'll be something like 300 odd amendments which will be made to the different tariff lines. And in a way of speaking, it'll be overhauling and rationalizing the Indian tariff for the levy of customs. As it's stated, to also keep up with the times, to incorporate new tariff items and new tariff lines and the change in technology that we have. So these are the key talking points that we have on the indirect taxes side today.
Thank you, Ranjit and Rishi. I know that it's always a very technical set of provisions, and I'm getting feedback. If you could, whoever's got their microphone on. So I know it's a very set of technical provisions that are important in their details. So I'm going to ask you to take a step back, both of you, and Dinesh, your thoughts. One of the biggest challenges was the need for expenditure, even as companies and others were clamoring for tax cuts, and the need for expenditure to boost the economy, even as companies requested the tax cuts to allow themselves to survive. Based upon some of the technical provisions that you've gone through, the specifics of it, Dinesh and Ranjit and Rishi, what are your thoughts on how this balance was achieved?
Nilima, Ajay here.
Please go ahead.
Are you able to hear me, Nilima?
Yes, I am. And Devika, can we spotlight Ranjit,
Yeah.
please?
So,
Yep.
sorry. So, Nilima, one of the things was the finance minister in the budget speech very categorically said that there is absolutely been no change in the quality of spend that the government has been doing. And she laid out numbers to say how those spends have been, been undertaken by the government. So now one thing is clearly the government does want to, like you rightly said, increased spending, and that could be one way of kickstarting or sort of reviving the economy given where we are. But at the same time, I think one balancing thing, or rather a great thing that's been done, is there's been no increase in taxes on any of the things. There was always an expectation. There's been a lot of discussions, right? Like in the US, what your Treasury Secretary has been talking of taxing M2M gains and things like that for the rich, introducing a surcharge. These were discussions that were happening in India as well. Now, not having done that, where the finance minister, I think, has done a commendable job in bridging the two, is really, I'm sorry to be talking in rupee terms here, 175,000 crores, is the number that she has projected for sales from disinvestment or from selling of some of the assets. She's listed, said that there will be 2 banks that are owned by the government, 1 insurance company that currently the government owns, and our largest life insurance company, 1 general insurer and the Life Insurance Corporation of India, are things which they would want to either list or sell to private so that they'll raise this money. They've also talked of a very nice way of putting some of the infrastructure projects, including our freight corridor and rail freight corridor, some of the ports, some of the airports, into a listed vehicle investment trust, which would be listed on the stock exchanges and raise money. I think in terms of not raising the taxes and maintaining the same level of expenditure, one big difference has been the amount that would be raised with disinvestment of government assets.
Wonderful. Thank you. Let me reiterate that for those of you who are on the Teams platform, you can ask your questions in the chat function. You can press the little icon. You can also raise your hand. And for those on the phone, you can send myself or Devika an email to ask that question. So Abhishek Kishore, you had a question?
Thanks, Nirmala. Thanks to the Dhruva team. Just one very quick question, specifically, Ranjit. I understand that there is some change in the definition of equalization levy, but how does it impact on the ground? What would the companies end up paying additionally, if there is any additional tax or anything? But is there any change in it, or is it still 2%?
Abhishek, that's a good question. One is, it is still 2%.
Okay.
There's no change in the rate. What has happened is they've sort of, and I'm using the word carefully, they have in a sense expanded the definition or the scope or ambit of equalization levy. Now, This was introduced last year. They had brought it in on all online sale of goods or online provision of services. So this was really aimed at digital services.
Correct.
It was very wide. So there was always a doubt that if there are some aspects of a transaction are done digitally, but it's essentially a sale in the brick and mortar or physical mode, would it get covered? Now, what they've gone and done this time, Abhishek, is they have expanded the definition to say that even if one of the activities, such as acceptance of a purchase order, acceptance of an agreement to sell, or even acceptance of payment of online, is sufficient to make it a digital trade. So this would impact, because you could conclude the contracts. You may not use an online platform. You may not use a marketplace. It need not even be traditional e-commerce, so to say. But if one leg or one aspect of the transaction is done online, then it would today get covered under the equalization levy.
Okay.
So we'll have to sort of revisit some of the business models to see if they are applicable now, given this clarification, because they've amended it and they've said this is how it is to be read. Therefore, some of the things which we thought would be outside the scope of equalization levy today could get covered, but it'll still be covered at 2% itself.
Okay. All right. Thank you.
Thank you. There is a question from the insurance folks. Steve Simchek, I'd like, if you could, to introduce yourself so that Dhruva understands the organization that you represent, and then your question on FDI. If you're able to. The question, if he's not able to, the question is, how soon will the insurance changes be implemented?
So the insurance change has been announced to say that it will now be 74% foreign investment that will be permitted. This is just a government order that has to come. It's a press release or a press note, as we call it, that has to get issued. And it does not require a parliament approval or any of those things. So it could technically happen as soon as tomorrow morning, right up to a few weeks for them to sort of issue that notification. But that's anybody's guess, Nilima. But I would think that they may do it closer to end March or thereabouts, so that it is closer to the next financial year. But I'll not be surprised if they even issue it in the next 2-3 days. So we'll have to just wait and see.
Well, as you know, that's a very important and critical change that's happened, and a number of our companies are waiting for it. We have a couple of questions. I'm going to let Nisha Biswal, our president, ask her question first. And for those of you, please retype your question if you can. I'm not able to see them all. And if you, due to a technical side, glitch on my side, but we will try and get to all of them. So Nisha, you please go ahead, and then Swati Samadar, I'll ask you to go next. Nisha, are you able to unmute yourself? All right, so let me, while she does that, let me ask the question from Swati Samadar. Can you confirm if the pure licensing of software or the leasing or renting of equipment and products through a foreign digital platform to local users is subject to the equalization levy, or does it come under regular treaty provisions? So if you let me just read that question again for all of for all of our listeners.
Nilima, I got that. Let me just summarize that question. And the question is really if licensing of software would get covered under equalization levy, or would it be under income tax at this point? Because the way our equalization levy works is once something is liable to equalization levy, there's an income tax exemption. Therefore, last year there was a view that pure sale of software could actually get covered under equalization levy because it's a provision of services, online services, and therefore not liable to income tax. And the rate differential was that equalization levy was 2%, and if it was royalty, then it would be 10% tax. Now they have actually in this budget introduced a provision which seeks to clarify that licensing of software, if it is royalty, if it's held to be royalty or fees for technical services, will actually be liable to tax as fees for technical services or royalty, and will not get covered under equalization levy. So any sale of software, if it's going to amount to royalty under the treaty or under the domestic law, then it would be liable to income tax together with the treaty, and not be liable to equalization levy.
Wonderful. And we only have one last question that I've received by email. The NPAs have been a problem in the past decade. From a macroeconomic standpoint, COVID has intensified this problem. Some say it's going to double when the true extent is realized. What the budget has done, do you feel it's enough? Or do you feel that more can be done?
Nilima, the way our banking works and the issue and the magnitude of the problem on NPA, there's always more that can be done. So I think there are two things here. One is the recognition of NPA has sort of been muted because of something that our Supreme Court has done. So there is one school of thought that the banks are today not recognizing NPA because what the Supreme Court did is provided a period of, so to say, moratorium because of the pandemic to say if there are, loans which have become bad, don't recognize them at this point, defer it by a few months because, businesses could have been stressed and could not have made the payment, and therefore you ought not to be recording those NPAs. That's really, I think, where the question is coming from, that the true sense of the NPAs could be much higher, which could be the case. There were a few announcements in the budget today about setting up institution for bad banks, taking care of those things. I think some of those are in steps in good direction, but the true effect of what the NPS are and how much they actually are will only be known in a few months after banks start making the real provisions.
Wonderful. I know we've gone over, and I want to thank everyone for staying. So to you, Ajay, and of course, Dinesh, for joining us, and Ranjit and Rishi, thank you all for taking the time to share with us sort of the critical developments that have happened. We look forward to hearing from you. We have received requests for your presentation, which we'll be sharing this. This event itself will be available for viewing by members who were not able to join. And so to all of you, Dinesh, and your experts, I want to thank you for walking us through some of the most important provisions of the 2021 and 2022 budget. Thank you all. And Dinesh, I'll just let you close us out. And before you do so, I'd like to thank Alexander Slater and Devika Singh for their support on this from our side. I know you have a team helping you as well. But Dinesh?
Nilima, I think Dinesh seems to be having some issue on the connection or whatever. I'm not able to see him, so I don't think we need to.
Well, thank you one and all for taking the time to join us. Don't hesitate to reach out with questions, and we'll circulate the presentation. So Ajay and Ranjit, thank you so very much.
Thank you.
Thanks, everyone.
Thank you, everybody.
Thanks. Bye.